Thank you for watching this presentation. This paper is joint work with my PhD student Sven Lerner and Svetlana Briskalova from LBS and Martin Letter from UC Berkeley. So this paper is about firm fundamentals or firm characteristics. That is, for example, the book-to-market ratio of a company, the size of a company, or based on past returns. And firm characteristics are crucial for asset pricing. We use firm characteristics to construct investment strategies. These could be simple portfolio sorts or prediction of returns. We use firm characteristics to construct reduced form asset pricing models, for example, factors. And we also use firm characteristics to construct test assets or basis assets. Now, the fundamental problem is that we have a lot of missing data for firm characteristics. Not every company has all firm characteristics observed. Now, this problem becomes massive if we require a company to have multiple characteristics observed at the same time. So if we want to solve Cochrane's multivariate challenge, we cannot avoid to deal with missing data. Now, this paper answers two questions. First, how much of a problem is missing data? And second, how should we deal with it? Obviously, missing data is a problem, otherwise we would not have written this paper. And the way how the literature is currently dealing with it is very ad hoc. So in many empirical papers, only a subset of the data is used that has fully observed data. Now, as we will show, this will lead to a selection bias. And other papers use very ad hoc ways to impute missing data, either by simple cross-sectional averages like the median, or by just using the last observed observation. This will also lead to a strong bias. Now, in this paper, we will first document patterns about missingness and establish a number of key facts on missing characteristics. Second, we will propose a novel method to impute missing values. And third, we will study the asset pricing implications. For the first contribution of this paper, we conduct a comprehensive empirical study on the structure of missingness. We show that missing data is prevalent. Almost all characteristics have missing observations, and that affect small and large companies, young and mature companies, profitable and distressed firms. Second, the problem of missingness is massive when we require companies to have multiple characteristics observed. In our sample, if we want to use only those companies that have all characteristics observed, we would throw away around 70% of all companies. And those companies would represent 50% of the market capitalization. So that's a big problem. Third, data is not missing at random. There are systematic patterns in missingness. So if a certain characteristic is missing at one point in time, there will be clusters over time. So it's missing in blocks. If a certain characteristic is missing, other characteristics will also be likely to be missing. More importantly, companies that have observed data are different from companies that have missing data. So companies that have missing data tend to be smaller stocks, and the more extreme realizations tend to be missing. Fourth, returns depend on missingness. We show that companies that have observed data tend to have higher expected returns than companies that have missing information. We will also document that missingness has a price impact even on simple long-short type strategies. So overall, we document that there are widespread implications for asset pricing of how we deal with missing data. Second, we provide a solution to how to deal with missing data, and we propose a novel method to impute missing values. Now, imputing data is challenging for a number of reasons. So first, when we impute data, we want to avoid an omitted variable bias. So characteristics are predictable, but we want to ensure that we use all available information to predict the missing values. Second, we want to avoid a selection bias. As I mentioned before, companies that have observed data are different from companies that have missing data. And that needs to be taken into account. So if we estimate a model on observed data, we need to ensure that it will be valid on the missing data. Let me give you a very simple example. Let's consider one company for which we do not observe the book-to-market ratio. Now, if this company tends to be also small, then we know that small companies tend to be value stocks. Then using a cross-sectional median would lead to an omitted variable bias, because a small company should have a book-to-market ratio that's above the median on average. Now, second, we know that more extreme realizations tend to be missing. That means if we just take the median, we would also create a selection bias. Now we will propose a new method for imputation. The type of data that we deal with is a three-dimensional tensor, because our data will be many stocks for many characteristics for many time periods. And we propose a cross-sectional and time series factor model for characteristics. When I talk about the cross-section, I mean contemporaneous cross-sectional dependencies. For example, that small stocks tend to be value stocks. When I talk about time series information, trying to leverage the persistence in characteristics. For example, the market capitalization, the size of a company is very persistent. So if I observe in the past the size of a company, that should give me valuable information for how missing data could look like. What is very important is that our method will allow for very general missing patterns. So we allow for general heterogeneity in missingness, and most importantly, we allow for this kind of endogenous missing pattern. So the missingness can depend on the factor model itself, and that allows us to capture that more extreme realization tend to have a higher probability of missingness. Overall, our method to impute missing data is a data-driven approach. It's very transparent and simple to implement. However, we show empirically in a comprehensive out-of-sample study that it works extremely well. We have 40 to 50% smaller errors in imputing missing values relative to the existing benchmarks. We also show that it's important to use both this contemporaneous cross-sectional information and the time series information to impute missing values. As part of our contribution, we will construct a reference data set similar to Kenneth Range data library, where we will impute missing values that researchers can use for their follow-up applications. Let me be very brief when it comes to the related literature. So there are only very few papers that deal with missing financial data. One very nice paper is by Freiberger, Neuhirl, and Weber. So that paper is complementary to our work because of a different focus. They're trying to deal with the problem of how to adjust a GMM estimation in the presence of missing data. Our focus is to provide imputed value for general purpose follow-up applications. So there are different assumptions that these two papers make about the missingness itself and about the data generating process. So in our case, we will assume a factor structure and characteristics, and we show that empirically, this is a very good model. Now, I also want to mention another problem that was identified in another paper that I have with co-authors, and that's about the look-ahead bias. So if I use all the data that I have available to impute missing values, and then use this imputed data to evaluate the out-of-sample performance of an investment strategy, I will have an implicit look-ahead bias sneaking in because I used all the data for imputation. So in this other paper, we show how to deal with that problem, and we clarify what the implications are. I also want to emphasize that missing data and imputing missing data is actually very closely related to causal inference. In causal inference, we either observe the control or treatment units, but not both at the same time. Now, the counterfactual outcome can also be modeled as missing data. In imputing data is similar to estimating a counterfactual outcome. And there we deal with a similar problem, namely that the control units can be very different from the treatment units. And that needs to be taken into account, similar to the non-random missingness that we have to deal with. There are a number of papers that deal with missingness in a panel setup. And remember, in our case, we have a three-dimensional data set. In a panel setup, we only have 2 dimensions. So the companion paper that I have with Rushang Xiong, that is the basis for the method that we use in this paper. There are a number of other papers, for example, work by Bai and Eng. These different papers differ in terms of the assumptions that they make on the missingness. Now, in our case, we find that the assumption that our approach allows us to have is very well suited for the patterns that we find empirically for characteristics. So again, one distinguishing factor for all these different methods is how they can deal with general missing patterns. Now, factor model. So in our case, we will estimate a factor model for imputation, And factor models have a long history in finance. Now, usually factor models in finance are applied to returns. We show, and we find that is an interesting empirical finding by itself, that the characteristics themselves have a factor structure. Last but not least, there's an exciting literature that uses big data to either predict returns or to estimate the stochastic discount factor. Now, all of these papers, either explicitly or implicitly, need to make assumptions about missing data and need to make choices of how to deal with that. One noteworthy paper is the work I have with Stein and Ron, where we are actually using one of the methods that we present in this paper to deal with missing data. Now, let me come to the empirical findings. Now, the data set that we are using is a very standard data. So it's based on CRISP CompuStat. We have around 50 years of monthly data, and we have the most relevant 45 characteristics that have been shown to be important for asset pricing. So they are based on value information, investment profitability, intangible past returns, trading frictions, etc. Now, we will use centered rank quantiles for the characteristics, and I will discuss this later. This is without loss of generality. Now, our characteristics are updated at the highest possible frequency. That means, for example, that the size of a company will be updated monthly, and the book-to-market ratio would be updated quarterly because we have book values available only every quarter. Now, when I present results about the proportion of missing data and I use quarterly characteristics, I only refer to the quarterly observations, right? So I want to emphasize that with our approach, we can deal with mixed frequency data in the sense that we can impute the higher frequency observations. But when I present results, I will always take the updating frequency into account. So the main point here is we use a very standard data set that has been used in many empirical asset pricing papers. So first, we want to understand how much data do we have and how much of this data is missing. So what I'm showing you here is the number of stocks that we have for our sample. So the number of stock peaks around 8,000, and then at the later part of our sample, it will be around 4,000 to 5,000. Now, I'm also showing you the number of stocks that have certain key characteristics available. Now, if I look at the light blue line, that would be investment, you can see that at the beginning of our sample, many companies do not have investment information available. At the end of the sample, around 20 to 10% of the companies do not have investment information. So overall, there's a lot of heterogeneity in when firm characteristics are missing over time, and also among the different firm characteristics. Another example would be real investment over assets. This is missing for around 50% of the companies throughout our sample. Now, the big elephant in the room is when we have to deal with multiple characteristics. If I want to include only firms that have all 45 characteristics available, then I would end up with a percentage indicated by this dark blue line. So if I use only those with fully observed data, I would throw away over 70% of all firms. And those firms would represent around 50% of the market capitalization. That is huge. Now, this is not driven by one particular characteristic. If I allow up to 3 characteristics to be missing, that can be different characteristics for different firms, I end up with this black line. So in that case, I would still throw away 50% of the companies. If I want to have around 95% of the companies included, I would need to allow for up to 35 characteristics to be missing out of our 45. So it means missing data is a huge problem for all applications that require to have multiple characteristics observed. That is the case if we run a regression on a panel of characteristics, when we build conditional factor models, or that's the case also for many machine learning applications. Now, how is the missingness related to the size of a company? Now, here I'm showing you the percentage of missing observations for different size quintiles. So the light blue line is the 20% smallest companies, the dark blue line are the 20% largest companies. So we observe that small companies have more missing values than large companies, and that's not surprising. The difference is particularly large at the beginning of our sample, but at the end, this difference becomes smaller, and even large companies have a large number of missing observations. Now, the next question is, when are characteristics missing? So here I'm showing you for all 45 characteristics, the percentage of missingness. So you can see that many characteristics have around 20% of missing observations. Now, what I'm also showing you here is when are characteristics missing. So characteristics can be missing at the start. That means there's no prior observation. They can be missing in the middle. That means there's some prior observation, some later observation, or they can be missing at the end. Now, missing at the beginning can be mechanical if you have a new young company, which by construction doesn't have any history. So characteristics like long-term reversal that are based on a long history of observations, they have a lot of missingness at the beginning of the sample. But the main takeaway from this slide is that we have missingness at the beginning, the middle, and the end for most characteristics. And a second takeaway from this slide is that what is available has an impact of what type of imputation method we can use. So an imputation method that is based on using prior observations cannot be applied if we have missingness at the beginning. The next question is which stocks have missing observations? So here I'm showing you for a number of key characteristics, the percentage of missingness for the 5 size quintiles. So the black line is the overall aggregated value. And as we have observed before already, small stocks in the first size quintile have more missingness than large stocks in the larger size quintile. However, there are complex interaction effects with size. For example, investment, that's the light blue line, small companies have around 45% observations missing, while large companies only have 20% of investment information missing. So again, this indicates that missingness is not random, but the companies that have missing observations are different from those that have observed information. Now, which characteristics realization are actually missing? This is a tricky question because by definition, we do not observe the missing values. So what I'm doing here is a very simple exercise. I'm looking at a company and I'm considering what is the average characteristic realization, and then I calculate for these companies what's the percentage of missingness. For example, the light blue line tells me that companies that are on average small investment companies have more missing observations than companies that are on average medium investment companies. Similarly, companies that have large investment on average also tend to have more missing observations. So this kind of U-shaped pattern holds for all characteristics. So this indicates that more extreme realizations are more likely to be missing. What this means is also that missingness is endogenous. It depends on the actual realization of the characteristic. And that makes it a very challenging statistical problem to deal with. Now we will talk about how to impute missing data. But in order to do that, we need to leverage some form of dependency in characteristics. There will be 2 types of dependencies, time series and cross-sectional. So here I'm showing you the autocorrelation for my 45 characteristics. More persistent characteristics are on the left and more volatile characteristics are on the right. You can see that many characteristics are highly persistent. For example, the size of a company, the market capitalization, has a very large autocorrelation coefficient. So what it means is if I observe the size in the past, this is very valuable information to impute future values of the size of a company. So it also means if we do not take the prior or potentially also future information into account, we will incur an omitted variable bias. Now, the second dependency comes from contemporaneous cross-sectional information. So this relates to that small companies also tend to be value stocks, right? They tend to have larger book-to-market ratios. What I'm showing you here are pairwise correlations for characteristics averaged over time and stocks. What you can see is that there are strong cross-sectional dependency patterns. So we observe this kind of clusters that tell us that if we observe some characteristics within the cluster, they have a lot of information about potentially missing characteristics. Now, it also shows us that we do not know a priori where the dependencies are, and this dependency can be quite complex. But one way to estimate these type of dependencies from the data are latent factor models. And so in the following, I will combine latent factor models for this contemporaneous cross-sectional dependency with time series information. that brings me to the model part. So our data set will be three-dimensional tensor. So I have around 6,000 stocks that I observe for 600 months for 45 characteristics. Now I want to estimate a low-dimensional model for this three-dimensional tensor. As I mentioned before, we are going to use centered rank quantiles. These have the advantage that they're more stationary in the cross-section over time, and they automatically deal with outliers. So we show in the paper that rank quantiles are the more appropriate transformation of the data to model. And once we have a good imputation method for rank quantiles, we can always map it back into the raw characteristics by using the empirical density function. We do this in the paper, and we show that it works very well. Now, let me start first with the cross-section information. So what I'm going to do now is I will take a specific time period, and then I'm ending up with a two-dimensional problem. So I will have stocks, different stocks, and different characteristics. So for this two-dimensional matrix, I will assume an approximate factor structure. That means this contemporaneous dependency should be captured by a small number of latent factors. Now, if I do not have missing values, I could estimate these latent factors with principal component analysis that I apply to what I call a characteristic covariance matrix. However, here we have missing values. So we will use the methods that we have developed in our companion paper together with Ruosheng Zhang. So it has two steps. First, I will create an estimate of this characteristic covariance matrix. And I do it by by calculating the covariance between two stocks using only the observed values that these two stocks share. So more specifically, let's assume I have a stock I and a stock J. Now I estimate the covariance between these two stocks by using only the characteristics that are available for both of these two stocks. Now this essentially tells me how similar two different stocks are. Now the eigenvectors of the largest eigenvalues of this characteristic covariance matrix are the estimates for my characteristic factors. Now I estimate the characteristic loadings by running a cross-sectional regression averaged over the different stocks. Now W is an indicator that is 1 if the characteristic is observed and 0 otherwise. So this is a weighted regression where I only use observed values. And what is really nice, this type of regression automatically takes care of very general missing patterns. And it does it without the need to explicitly model the dependency structure of the missing patterns. Now, in our companion paper, we show that this estimator is consistent, and we prove the asymptotic inferential theory for this estimator. Now, characteristic data is actually very well described by a factor model. What I'm showing here are the eigenvalues of the average characteristic covariance matrix, and we observe this typical pattern that we have in the case of a factor model. So here we see that around 4 to 9 factors capture a lot of dependency in the characteristics. Now we have an extensive discussion in our paper about the right number of factors. So the way how we do it is we evaluate out of sample the root mean squared error for imputation for different number of factors. And we show that for monthly characteristics, the optimal number of factors would be 6. For quarterly characteristics, it can be beneficial to add some more factors. But overall, we show in a very extensive study that a 6-factor model is a parsimonious and very robust model for imputation. So moving forward for the rest of this talk, I will use a 6-factor model. What is also nice, these factors have a clear economic interpretation that can be related to the clusters that we have seen in this characteristic covariance matrix. Now let's come back to the elephant in the room, and that is about the complex missing structure. So data is not missing at random. If I would simulate data missing at random based for different stocks and different characteristics, it would be the plot on the right here. So yellow means missing data. Now on the left, I show you representative months. And what you can see here is that missingness is definitely not at random. There are certain clusters in this cross-sectional dimension. If we look at the time series, there are also clusters. So when data is missing, it happens in blocks. And the average block size tends to be 1 year. Furthermore, as we documented before, there's some endogeneity as well in the missingness. All of that needs to be taken into account when we do imputation. Now, our approach will allow for very general missing patterns. So the W indicates if characteristic L for stock I at time t is missing, and the probability of missingness can depend in a very general way on time. The reason is because at every time t, we estimate a separate model. So there's no assumption that we assume about the temporal structure here. That means we can deal with block missingness, mixed frequency missing data, dependency of the missingness on prior missingness, etc. All of that will be captured. We also allow for general heterogeneity for different characteristics. That means, for example, that investment can have a higher probability of missingness in book-to-market ratio, for example. And most importantly, we allow for a very general missing pattern that can depend on individual stocks I. In more detail, the probability of missingness can be a very general function of the stock-specific characteristic factors. That's a way how we can capture that more extreme realizations are more likely to be missing. Of course, we need to impose some identification restrictions. So what we assume is that the missingness is independent of the loadings and the error terms. So intuitively, what this means is when we calculate the sample characteristic covariance matrix on the partially observed data, the eigenvectors of the largest eigenvalues are the same as if we would estimate this characteristic covariance matrix and had no missing data. So what it means intuitively, given the partially observed data, we can identify which stocks are similar. Now, we need an assumption of this form. There's no way around it. And we believe that this assumption is reasonable and makes sense. Okay, so far we have only the cross-sectional dependency, and we also want to include the time series information. There's actually, and we propose a very simple way to do it, which works empirically quite well. So we just add to the cross-sectional factors prior time series information for a specific characteristic in a specific stock. And then we run a regression, so we get a loading that captures the contemporaneous cross-sectional information and the time series information. We call this model the backward cross-sectional model because it uses past information and the cross-sectional information. We could also use future information. We call this a backward-forward cross-sectional model. Now, our framework includes a lot of important special cases. So a pure time series model would be included if we don't have these cross-sectional factors in our model. If we just use the last observed value, that's a special case of a time series model. A cross-sectional median model is also a special case of our model. Now, the estimation is again this cross-sectional regression that only uses observed data. So instead of just running this regression on these cross-sectional factors, we now include the cross-sectional factors and the prior or potentially future time series information. We stack them together. Then we run this regression averaged over the observed stocks. And all the inferential theory and statistical results from before will carry over to this setup. This means, in summary, we have different models. So the most general model would be the backward-forward cross-sectional model. If we only use backward information and the cross-sectional information, we have the backward cross-sectional model. We'll also consider a forward cross-sectional model, a pure cross-sectional model, and a pure time series model. And the current standard used in the literature, like the previous value and the cross-sectional median, will also be part of our analysis. So one last point. As I said before, we are estimating our models every month. We will call this local models. So these local models have the advantage that they can allow for time variation, and they avoid a log-ahead bias because they don't use future information. Now, empirically, we show that these characteristic loadings and these beta coefficients stay the same over time. If we assume that these loadings and betas are constant over time, we can estimate them with a pooled regression. So we just stack all the time series observations together into one larger vector. Now, this has the advantage that we're using more data, so we should get more efficient estimator. There is a certain cost that we're paying, namely, if we use future information, we also will have a log-ahead bias. Now, let me come to the empirical results. So I will present root mean squared errors for our imputation. So the way how it's going to work is I have our data set with observed data, and I'm going to mask part of the data. And then I use this data where I've masked entries to estimate my model, and then I compare the imputed values with the actual realizations to get my root mean squared errors. Now, we will report root mean squared errors averaged over all dimensions, or root mean squared errors for each characteristic or each time period. Now, in extension, in the revision of our paper, we also report other metrics like absolute value errors or the errors for specific quantiles. Overall, the qualitative findings that I get with root mean squared errors carry over to these other metrics. So the way how different methods compare to each other is the same for all these different evaluation metrics. Now, we also consider different ways of masking data. So for this presentation, I will use out-of-sample block masking. That means I will mask 10% of the characteristics in blocks of 1 year. So this captures the empirically observed pattern that data is missing in blocks. We will also include missing at random in our analysis. And in an extension that we have done in our revision, we will also estimate a probabilistic model for missingness and use this probabilistic model to mask entries based on this empirical distribution. Now, the qualitative results with block missing masking are the same as for the propensity masking. And that is why, for the sake of this talk, I will just show the result for block missing. Now, here are the aggregated results. They're based on out-of-sample block missing. So I'm showing you all the different imputation methods and their root mean squared errors. So the best model indicated in bold, if I want to have no log-ahead bias, would be the local backward cross-sectional model. The best model that uses all data, that would be the global backward-forward cross-sectional model. Importantly, the root mean squared errors that we have around 40% lower than what you would get if you use a cross-sectional median or the industry median for imputation. So this is really suboptimal to use a median. We also get better results than if you use simply the previous value. It's also a substantial improvement. Now, these were the results aggregated over all characteristics. We can break it up into quarterly updated and monthly updated characteristics. And the relative ranking of the methods and the magnitude and the differences are very similar to the aggregated results. We will also separate the results for missing at the beginning, in the middle, and the end. Now, importantly, when I look at missing at the beginning, I cannot condition on prior observations. So the best log-ahead bias-free model would be the local cross-sectional model, and the best model that uses all information would be the global forward cross-sectional model. The relative difference between models is quite similar to the aggregated results. So we do substantially better compared to simple median imputation. The results from missingness in the middle are again quite similar to the aggregated results, and the relative ordering of the models is still the same. Last but not least, for missing at the end, again, our local backward cross-sectional model performs much better than the current standard, and the best model using all the data would then be the backward cross-sectional global model. Obviously, we cannot condition on forward future information. Now, let me illustrate how imputation works with a couple of examples. So first, I will start with the size characteristic, the market capitalization. That's a very persistent characteristic. Another example that would be quite similar would be total assets or dividend price ratios. Now, here I'll look at a representative stock, which is Microsoft. So our characteristics are standard rank quantiles, so they take values from plus 0.5 to minus 0.5. Now here, there's an orange line that shows the observed entries. The gray shaded areas are the blocks where I mask data. So this is my out-of-sample evaluation part, and the black line will show me the true values in these out-of-sample periods. And I will look at two imputation methods. The backward cross-sectional, that's in blue, and the red one is backward-forward cross-sectional. And as you can see, all these lines are essentially the same. That means our model is very good in imputing missing data. We also include in light blue a simple median imputation. And this is terrible. So you can see that we not only get the cross-sectional ranking really wrong, but also the time series pattern of the characteristic would be highly distorted. So if I would use the observed data for size, then when it's missing a user cross-sectional median, then I go back to the observed values, I would get jumps in my characteristic time series, which are completely spurious. Now let's have a look at a more interesting characteristic, and that would be operating profitability. And this is more volatile, but still has some degree of persistence. Other examples that would be similar would be book to market, earnings price ratios, or investment. What you can see here is that the blue and red lines, these are imputation methods, work really well in sample and also out of sample. If you use the backward cross-sectional model, you're essentially anchoring the imputation method as the last observed value, and then you use the cross-sectional information to capture the variation within the out of sample period. If we use a backward forward cross-sectional model, we're using the starting and end point, and then we connect these 2 points using the variation estimated by the cross-sectional model. Again, using the median for imputation would be a terrible idea. Last but not least, I'm going to look at a very volatile characteristic. This is idiosyncratic volatility. Other similar example would be short-term reversal or momentum. We can see again that in and out of sample, our imputation methods capture the variation quite well. Now, for this example, prior observation is not very useful, so all the information comes from this cross-sectional contemporaneous factors. And again, using the median would just be a very bad idea. Now here I want to compare different imputation methods for different characteristics. So I have the more persistent characteristics on the left and the more volatile characteristics on the right, and different lines represent different imputation methods. So the black line is a global backward-forward cross-sectional model, and the red line is a local backward cross-sectional model. So the main takeaway here is that the ranking that I had in the tables from before holds essentially for all the different characteristics, right? So my 2 benchmark model, local backward cross-sectional and global backward-forward cross-sectional, they are the dominating models within their class. The second takeaway here is that if you have persistent characteristics, what matters the most is to include time series information. If we have very volatile characteristics, what matters the most is to include the cross-sectional information. We can formalize this more by looking what is the relative importance of the time series and the cross-sectional component in this beta vector. So here, the more volatile characteristics on the left, the more persistent characteristics on the right. So if I look at, for example, idiosyncratic volatility or short-term reversal, these characteristics put almost all their weights in this beta vector on the cross-sectional factors. They put very little weight on prior observations. On the other hand, if I look at a persistent characteristic like size, most of the weight is put on prior observations, and quite little weight is put on the cross-sectional information. But overall, we see that we need a model that takes both information sets into account if we wanted to work on all characteristics. And the last point I want to cover is about local versus global imputation. So here I show the local and global version of each of my models. There are many lines, but the main takeaway is that the local and global models are very close to each other. And the reason is this cross-sectional factor model is very stable over time. Also, the time series persistency patterns and characteristics is also very stable. Therefore, the global and local models will give us very similar results. Now, because a global model uses more information at once, in some cases, it can perform slightly better than the local model. All right, last but not least, we want to talk about the asset pricing implications. And the starting point is a very simple analysis. I will create value-weighted portfolios where I use a long-only portfolio that has all stocks that has a specific characteristics observed. For example, I create a long-only portfolio of all stocks for which I observe book-to-market ratio or profitability. This is a black line. Now, this is essentially evaluated market portfolio. And here we report the mean return for these portfolios. Now, I repeat the same exercise, but I will only include the stocks for which a characteristic is not observed. So that will be the blue line. This would be a long-only portfolio of stocks, for example, that do not have book-to-market ratio or do not have profitability information. Now, we observe that the risk premium of stocks that have missing data is systematically lower from stocks that have data observed. And an even more extreme result happens when we form these portfolios based on missingness, but we exclude missingness at the beginning. So we exclude young companies. That is the orange line. We see there's a dramatic difference in the risk premium for these stocks compared to those with fully observed data. Now, missingness also affects very simple sorting strategies. So what I'm showing here are decile sorts. So I will show you the results for value-weighted decile portfolios, and with a top and bottom decile portfolio. For these kind of portfolios are the building block for many asset pricing models, for example, risk factors. Then we'll show you the Sharpe ratio, mean return, and volatility for the top and bottom decile. In this case, I will use book-to-market ratio to form deciles using New York Stock Exchange breakpoints. And I will do it by considering different subset of stocks. So first, I form my decile, top and bottom decile, using all the stocks for which I observe book-to-market ratio. Then I only include stocks that, in addition to book-to-market ratio, also have size information available. Then in addition to size, they also need to have investment information available. Then in addition to investment, they also need to have cash flow to price information and so on. And as a last point, I require all 45 characteristics to be available, right? So I will have less and less stocks that I can include in forming these portfolios. Now, what we observe here is that if we require all characteristics to be available, we end up with less than 2% of all stocks in our decile portfolios. Now, we do this because there are many applications that require multiple characteristics to be observed. That happens when we do triple sorting or double sorting. We require multiple characteristics when we have a panel regression on characteristics, etc. Now, when we have less stocks in a portfolio, there should be less diversification, and we expect the volatility to increase. Indeed, for the top decile portfolio, based on book-to-market ratio, the volatility is going to increase when I have fewer stocks. However, remember, data is not missing at random. So it doesn't have to be the case that the volatility goes up. In fact, for the bottom decile portfolio, the volatility is actually going to decrease. More importantly, the risk premium depends on which stocks I include in my portfolio sorts. So the top portfolio will have an increase in risk premium when I include less stocks. The bottom decile will have a decrease in the risk premium if I include more stocks. So overall, there are very complex effects on the risk premium. Now, asset pricing metrics like the Sharpe ratio, the t-statistics, alphas, etc., they combine these two effects. So what we can observe here is that the Sharpe ratio of my decile portfolios is already affected when I require 3 or 4 characteristics to be observed at the same time. And there can be very large effects on these asset pricing metrics. Now, this was an example that used book-to-market ratio. Here I have another example that uses operating profitability. And again, the main takeaway is that there can be large effects on the risk premium and on asset pricing metrics, depending on which stocks we include in our sorting, right? So this has large implications when we think about the multiple challenge in asset pricing. Now, I've talked here about 2 characteristics, but of course, we have done the analysis for all of our 45 characteristics. So what I'm showing you here are the Sharpe ratios for the bottom and top deciles, where the dark blue bars are the bottom deciles when I use imputed data. This means a lot of stocks are included. The light blue line is if I use the bottom decile using the subset of stocks that have all 45 characteristics observed. And similar for the green bars. The main takeaway here is that for all of our characteristic values, we see changes. Sometimes we see very large differences based on which stocks we use to form these characteristic decile portfolios. This holds for all of our 45 characteristics. In many cases, the Sharpe ratio will decrease if we take a smaller set of stocks. And that is driven by the larger volatility that we get by having less diversification. However, it doesn't have to be the case for all of these strategies, because as I said before, data is not missing at random. And the effect on the mean returns is rather complex, and it can go up or down. So the most important takeaway from here is that there is a strong selection bias when we do asset pricing using only the subset of stocks that have fully observed data. So let me wrap up here. So we have, in this study, systematically studied the structure of missingness. We have shown that the missing data problem is pervasive. It will affect even simple investment strategies. Missing data is complex, and simple solutions do not work. We propose a new method to impute missing data. It is based on a factor model. It leverages time series and cross-sectional dependency in the data, and it automatically estimates the structure from the data. What is very important, it is valid under very general missing patterns. So overall, we think that given that big data and machine learning methods become more and more important in finance, the way how we deal with missing data will also become more relevant. And we view our paper as a first step to systematically deal with missing data. And as I mentioned before, our plan is to provide a public data library with imputed values that researchers can use for their follow-up applications. Thank you very much for watching this presentation.